Headlines today suggest the economic crisis is behind us, but if you look at the companies actually building our world, they are losing money on every job they signed months ago. To find the source of this disconnect, we have to look back to when geopolitical tensions first escalated. We saw Brent crude prices surge past $140 a barrel. Even though a subsequent ceasefire brought oil prices back down to the $90 range, the initial shock didn't just evaporate with the headlines. That energy spike launched an invisible inflation wave through the economy, one that is currently moving through every step of the supply chain. It starts with trucking. When oil hit $140, shipping companies globally adjusted their fuel surcharges. Because fuel is their largest expense, these prices are sticky. They rise instantly, but they stay elevated even when oil prices cool off. These surcharges act as a tax on every product moved by land or sea. Manufacturers, often locked into fixed contracts signed months ago, cannot renegotiate their prices to match. They have to eat the loss, which erodes their profit margins. Construction is feeling the heaviest blow. Contractors are legally obligated to finish projects at prices agreed upon when materials were cheaper. Today, thousands of contractors are effectively paying out of pocket to complete their daily work. This pipeline logic means that the inflation consumers will feel at the store in 6 months is already baked in today. Corporate business models are taking the damage right now, long before the public sees the bill. This creates a direct conflict for the Federal Reserve. They have two options to manage the economy, and both lead to significant damage. They could raise interest rates to fight inflation, but that would further crush businesses already struggling with high input costs. Pushing them further could trigger a deep recession. Alternatively, they could cut rates and print money to support the economy. This protects growth in the short term, but it rapidly devalues the dollar, meaning your savings buy less every month. Historically, the Fed prioritizes avoiding the headlines of a recession. Inflation is a slower, quieter process that can be blamed on external factors rather than policy choices. Since the Fed's primary incentive is to prevent an immediate economic collapse, an expansion of the money supply becomes the most likely policy response to the current supply-side crisis. This influx of new money doesn't hit the market uniformly. It creates a split between different types of assets. Traditional stocks are ownership in companies, and those companies need healthy earnings to grow. But as we've seen, corporate earnings are being hollowed out by the inflation pipeline. Cheaper printed money cannot fix a broken profit margin or rehire a laid-off worker. Bitcoin, however, has no corporate earnings to miss and no supply chain to reprice. It exists entirely outside of the operational system that is currently being damaged. Because it has no employees, no manufacturing costs, and a strict 21 million unit limit, Bitcoin acts as a direct sponge for new liquidity. There is no broken business standing between the printed money and the price of the asset. The same shockwave that erodes the fundamentals of traditional companies is what forces the central bank to expand the money supply, providing the very fuel Bitcoin was designed to capture. To see where we stand, we can look at Bitcoin's 2-year rolling return. This chart shows whether you would be in profit if you had bought exactly 2 years prior to any given date. In over a decade of daily trading data, this line has only dropped into negative territory 4 times. These moments represent extreme market compression. The first 3 times this happened, Bitcoin was trading in the hundreds or low thousands. Each of those negative zones served as a launchpad for massive, exponential bull runs in the years that followed. Today, we have entered that negative zone for only the 4th time in Bitcoin's history. This current market compression aligns with the historical sequence that preceded every major wealth-generating cycle in the asset's history. Large institutions aren't ignoring these numbers. This week alone, entities like MicroStrategy and major ETFs have moved to acquire thousands of Bitcoin, treating the current price level as a strategic entry point. These institutional buyers are tracking the conflicting pressures on the Federal Reserve, the need to support a weakening economy while managing the currency devaluation that follows. Rather than relying on corporate equities that are vulnerable to rising input costs, smart money is accumulating structurally scarce assets to hedge against the predictable expansion of the money supply.